You were taught that Milton Friedman was a heartless ideologue who wanted the poor to suffer, the rich to dominate, and corporations to pollute freely. You learned this in economics class, or from documentary footage carefully edited to make him look sinister, or from professors who mentioned his name with a dismissive wave. Maybe you read an article explaining how Friedman's failed experiment in Chile proved free markets lead to dictatorship. Or you heard he caused the 2008 financial crisis with his deregulation mania. Here's what nobody told you. Almost everything you believe about Milton Friedman is a deliberate distortion. I'm not talking about honest disagreements over policy. Those are legitimate and Friedman welcomed them. I'm talking about 5 specific lies that have been repeated so often they become accepted truth. Lies that fundamentally misrepresent what he believed, what he advocated, and what actually happened when his ideas were tested. You know that feeling when you cite Friedman in a conversation and someone immediately dismisses you with, "Oh, that guy who loved Pinochet," or "the one who said greed is good." That frustration you feel, knowing something's wrong with their characterization, but not having the specifics to refute it, that confusion is exactly what these lies are designed to create. Because here's the thing. If people actually understood what Friedman said and why, if they knew what he predicted that came true, if they saw the evidence he presented, many of their fundamental assumptions about economics and government would collapse. So instead of engaging his arguments, critics created a cartoon villain version of Friedman that's easier to dismiss. The real Milton Friedman was a Jewish kid from New Jersey who worked his way through Rutgers during the Depression, who spent his career methodically demonstrating what helps real people versus what sounds compassionate but causes harm. He predicted stagflation a decade before it happened. He explained why inflation is always a monetary phenomenon when Keynesian economists said cost-push forces caused it. He showed with overwhelming evidence that government programs created to help the poor often trapped them in dependency instead. But you weren't taught any of that. You were taught 5 convenient lies. If you've always felt something didn't add up about the standard narrative on Friedman, if you suspected the caricature was too simple, too convenient, your instinct is absolutely correct. You're not alone in sensing that intellectual dishonesty. In the next 15 minutes, I'm going to systematically dismantle 5 specific falsehoods you've been told about Milton Friedman, not with opinion or ideology, but with his actual words, documented historical evidence, and verifiable outcomes. You will discover what he genuinely believed versus what critics claim he believed. You'll see the empirical record. What happened when his ideas were tested in the real world? By the end, you won't necessarily agree with everything Friedman argued, but you'll have the intellectual tools to evaluate his ideas based on what he actually said, not on deliberate mischaracterizations. Subscribe to this channel where we cut through the distortions and explore what great economic thinkers actually taught. Because the truth is always more fascinating than the caricature. Let's start with the most pervasive lie, the one that's turned into a meme, repeated endlessly. Milton Friedman said greed is good. You've heard this. Maybe you've seen the clip from his 1979 Phil Donahue appearance, where Donahue asks about greed and Friedman responds about self-interest. The clip gets shared with captions implying Friedman celebrated Gordon Gekko-style avarice. Critics use it to paint him as a social Darwinist who worships selfishness. Here's why people believe this lie. Because there's a kernel of something in that Donahue exchange that gets stripped of all context and nuance. Because self-interest and greed sound similar if you're not paying attention. Because it's easier to attack a straw man who celebrates vice than to engage the actual sophisticated argument about incentive structures. Now watch what happens when you look at what Friedman actually said. Not the edited clip, but the full context. Donahue asked, "When you see around the globe the maldistribution of wealth, the desperate plight of millions of people in underdeveloped countries, doesn't that bother you? Don't you have a social conscience?" Friedman's response, "Of course it bothers me. I'm not in favor of poverty. But what's the best way to help those people? The free market has lifted more people out of poverty than any other system in human history. Where are people better off? in countries with more economic freedom or less. Then Donahue pressed, but what about greed? Capitalism is based on greed, isn't it? Here's what Friedman actually said. Is there some society you know that doesn't run on greed? The world runs on individuals pursuing their separate interests. The great achievements of civilization have not come from government bureaus. Einstein didn't construct his theory under order from a bureaucrat. Henry Ford didn't revolutionize the automobile industry that way. The only cases in which the masses have escaped from grinding poverty, the only cases in which the standard of living of the masses has experienced spectacular improvement, have been when the masses have had capitalism and largely free trade. Notice what he's not saying. He's not celebrating greed as a virtue. He's not saying greed is good. He's making a completely different point. That systems must account for how humans actually behave, not how we wish they behaved. He's asking, which system better channels self-interest towards socially beneficial outcomes? Think about the incentives this creates. In a free market, you profit by serving others, by producing something people voluntarily want to buy. In a government-controlled economy, you profit by pleasing bureaucrats and politicians. Which system better converts self-interest into widespread prosperity? Friedman's actual position was deeply moral. He asked, what actually helps the poor, feeling compassionate or implementing policies that empirically reduce poverty? The historical record shows capitalism has done more to alleviate material suffering than any alternative. That's not celebrating greed. That's caring enough about outcomes to follow the evidence. Here's what really happened in that Donahue exchange. Friedman was exposing the self-righteousness of critics who claim moral superiority while supporting systems that keep people poor. He was saying, you feel good about your intentions. I care about results. Let's look at which approach actually helps people. The lie persists because it's useful. If you can reduce Friedman to the greed guy, you don't have to address his actual arguments about how markets coordinate dispersed knowledge, how price signals allocate scarce resources efficiently, or how competitive forces discipline corporate behavior better than regulatory capture. But now you know the truth. Friedman didn't celebrate greed. He understood human nature realistically and asked which systems best serve human flourishing given that nature. There's a profound difference, and the people who taught you otherwise knew it. The second lie is more sinister because it carries moral weight. Milton Friedman supported the Pinochet dictatorship in Chile. This accusation appears in documentaries, academic papers, even protests where students demanded universities remove Friedman's name from buildings. You know how this narrative goes. Friedman visited Chile in 1975, gave lectures, met briefly with Pinochet, and Chilean economists influenced by his ideas implemented market reforms. Therefore, the logic claims Friedman endorsed authoritarian brutality, proved capitalism requires dictatorship, and his Chicago boys cause suffering. Here's why people believe it. Because the timeline is real. Friedman did visit Chile during Pinochet's regime. Because some Chilean economists who studied at Chicago did advise the government on economic policy. Because if you squint and ignore crucial context, you can construct a narrative of ideological complicity. Now, let me show you the documented evidence of what actually occurred. Friedman gave 6 lectures in Chile, technical academic talks about inflation and monetary policy. He met with Pinochet for exactly 45 minutes. During that meeting, he explained that economic freedom and political freedom are linked, that free markets naturally lead toward political liberalization. He explicitly told Pinochet that Chile needed both economic and political reform. Wait, let me show you something amazing. This isn't speculation. We have Friedman's own account, written contemporaneously. In a letter published in 1975, he wrote, I do not consider it as evil for an economist to render technical economic advice to the Chilean government, any more than I would regard it as evil for a physician to give technical medical advice to the Chilean government to help end a medical plague. Notice his reasoning. Giving technical advice on stopping hyperinflation, which was destroying Chilean living standards, isn't endorsing political repression any more than a doctor treating patients endorses their government. But here comes the really interesting part. Critics who call Friedman a Pinochet supporter conveniently ignore that he gave similar lectures in Yugoslavia, communist, China, communist, and Soviet bloc countries. He met with government officials in all these places. He consistently argued that economic freedom undermines authoritarian control, that free markets create independent power centers that challenge political monopoly. If visiting a country and giving economic advice means endorsing its political system, then Friedman equally supported communist dictatorships. But nobody makes that claim because it would expose the absurdity of the logic. Here's what Friedman actually believed about Chile in his own words from a 1991 interview. The really extraordinary thing about the Chilean case is that a military government followed policies that were radically different from the standard military or authoritarian government policies. They were willing to try free markets. That was extraordinary. But the economic reforms preceded political reforms. Economic freedom led to political freedom, exactly as I predicted. And you know what? That's exactly what happened. Chile's economic liberalization created a middle class that demanded political rights. By 1988, Pinochet lost a referendum and ceded power. Chile transitioned to democracy and became the most prosperous country in Latin America. The economic foundation preceded and enabled the political transformation. Compare Chile's trajectory to Venezuela. Similar starting points, opposite economic policies. Venezuela's socialism. Which country are people fleeing today? Which is collapsing living standards. The empirical contrast is devastating. The lie about Friedman supporting dictatorship persists because it's politically useful. If you can tar free market economics with association to Pinochet's brutality, you don't have to address whether the economic policies actually worked. You don't have to explain why Chile prospered while socialist neighbors collapsed. But the documented record is clear. Friedman opposed political repression everywhere. He gave the same advice to communist and authoritarian governments. Liberalize economically, and that will undermine your political monopoly. He believed in the inseparable link between economic and political freedom. The people who taught you Friedman supported dictatorship either didn't know these facts or deliberately omitted them. Either way, now you know what actually happened versus the convenient fiction. Here's the lie that gets repeated every time there's financial turbulence. Milton Friedman's deregulation mania caused the 2008 crisis. His anti-government ideology created the conditions for Wall Street to crash the economy. You've encountered this narrative in think pieces, political speeches, documentary explanations of the financial crisis. The story goes, Friedman convinced Reagan to deregulate. Banks ran wild without oversight. Predatory lending exploded and the whole system collapsed, proving government regulation is necessary. Here's why people believe it. Because Friedman did advocate removing harmful regulations. Because the crisis did happen after decades of his influence on policy. Because the narrative fits a convenient political purpose. More regulation must be the answer. If this revelation impacts you as much as it does me, he'll like so more people discover what really caused 2008, because the truth contradicts everything you've been told. Now, let me walk you through what Friedman would have said about 2008. And here's the fascinating part. He predicted crises like decades before they occurred, but for completely different reasons than the standard narrative claims. First, understand what actually caused the housing bubble. The Federal Reserve held interest rates artificially low from 2001 to 2004, cheaper than market rates would have been. This made borrowing for homes abnormally attractive. That's monetary policy, not deregulation. Friedman spent his entire career warning that Federal Reserve manipulation of money supply and interest rates creates boom-bust cycles. This was his core insight, the one he won the Nobel Prize developing. Second, government-sponsored enterprises Fannie Mae and Freddie Mac were buying and guaranteeing risky mortgages. These weren't private free market entities. They were government-created quasi-monopolies with implicit taxpayer backing. They purchased or guaranteed about half of all U.S. mortgages. Their existence distorted the entire market by removing normal risk assessment. Think about the incentives this creates. If you're a bank and you know you can sell risky loans to Fannie or Freddie, entities backed by government, why wouldn't you make those loans? The risk gets transferred from you to taxpayers. This is precisely the moral hazard Friedman warned about. It's not market failure. It's government intervention creating perverse incentives. Third, the Community Reinvestment Act pressured banks to make loans in ways they otherwise wouldn't have. Regulators graded banks on their lending to borrowers who didn't meet traditional creditworthiness standards. Banks that wanted to merge or expand needed good CRA ratings. So they made loans they knew were risky to satisfy political objectives. Fourth, deposit insurance through the FDIC meant depositors didn't monitor bank risk-taking because their deposits were guaranteed. Banks could pursue risky strategies without depositors withdrawing funds. Again, government policy removing natural market discipline. Let me show you something Friedman actually wrote in 1999, nearly a decade before the crisis. The use of quantity of money as a target has not been a success. I believe the only way to prevent a future inflation is to abolish the Federal Reserve. He saw that central bank manipulation inevitably created instability. Notice what's missing from the actual causes. Free market deregulation. The crisis happened because of government intervention, artificially low interest rates, government-sponsored mortgage buyers, regulations forcing risky lending, insurance that removed market discipline. Here's what really happened versus what was promised. Politicians promised that Fannie and Freddie would make homeownership affordable for everyone. Friedman would ask, at what cost? Who bears the risk when things go wrong? The answer, taxpayers, to the tune of hundreds of billions in bailouts. Critics will say, but Glass-Steagall repeal. Here's the problem with that argument. Canada had no Glass-Steagall equivalent and didn't have a banking crisis. The UK never had such separation and survived better than the US. Meanwhile, purely investment banks like Lehman collapsed while commercial banks with investment arms like JP Morgan survived. The empirical evidence doesn't support the Glass-Steagall theory. Friedman didn't cause 2008 through deregulation. Government policies created the bubble through monetary manipulation, risk socialization, and regulatory pressure for risky lending. Blaming Friedman is exactly backwards. His warnings about government intervention causing instability were vindicated, not refuted. The lie persists because the alternative is politically unacceptable. That government created the crisis it then claimed only more government could solve. The fourth lie carries emotional punch. Milton Friedman only cared about the rich. His policies benefited the wealthy at the expense of everyone else. You've heard variations on this theme. That tax cuts were giveaways to the rich. That opposing minimum wage meant wanting workers to suffer. That privatizing Social Security was a Wall Street scheme. The narrative paints Friedman as a shill for the wealthy, indifferent to ordinary people's struggles. Here's why people believe it. Because Friedman opposed many policies framed as helping the poor, minimum wage, welfare programs, public housing. Because he supported policies the wealthy tend to favor. Lower taxes, less regulation. Because if you judge only by rhetoric rather than results, his positions sound harsh. Now watch what happens when you examine who actually benefited from Friedman's ideas and who suffered from the policies he opposed. Take minimum wage. Friedman called it the most anti-black law on the books. That sounds provocative until you understand his reasoning. When you mandate that employers pay $15 per hour, you're pricing low-skilled workers out of the market entirely. A teenager with no experience isn't worth $15 per hour to an employer, so they don't get hired at all. Who does this hurt most? Young people, minorities, those with limited education. Precisely the group's minimum wage supposedly helps. The evidence overwhelmingly supports Friedman's analysis. Every time minimum wage increases, unemployment rises most among the group's minimum wage advocates claim to help. Black teenage unemployment is chronically twice that of white teenagers. Exactly what you predict if minimum wage prevents entry-level employment. Friedman wasn't heartless. He cared enough about actual outcomes to oppose feel-good policies that demonstrably harm their intended beneficiaries. He asked, what matters more, your good intentions or the real-world effects on real people? Consider welfare programs. Friedman documented how the war on poverty created dependency rather than alleviating it. Before massive welfare expansion in the 1960s, Black family formation was strong and poverty declining. After welfare programs that penalized marriage and work, family breakdown accelerated and poverty became entrenched. This isn't speculation. The data is stark. In 1960, 22% of Black children lived in single-parent homes. By 1990, that number reached 65%. What changed? Welfare programs that paid more for households without fathers present. Friedman pointed this out not because he wanted families to suffer, but because he saw that programs designed to help were creating catastrophic social damage. Here comes a really interesting part. Friedman proposed an alternative that progressives today are rediscovering. Negative income tax. It's essentially universal basic income. Direct cash payments to the poor with no bureaucratic strings, no means testing cliffs that discourage work, no government paternalism deciding what people need. Wait, the heartless free market economist proposed giving poor people direct cash? Yes, because unlike the professional poverty industry that benefits from administering programs, Friedman actually cared about outcomes. He recognized that cash transfers respect human dignity and agency while avoiding the perverse incentives of traditional welfare. On tax policy, critics claim Friedman's support for lower taxes only helped the rich. But look at what actually happened. When Reagan cut top marginal rates from 70% to 28%, tax revenue from the wealthy increased. How? Because lower rates reduce incentives for avoidance and increase incentives for productive activity. The rich paid a higher share of total taxes after the tax cuts to the rich. Meanwhile, lower taxes benefited everyone through economic growth. The 1980s saw millions of jobs created, rising incomes across all quintiles, and the longest peacetime expansion to that point. The prosperity wasn't just for the wealthy. Median family income rose, poverty fell, opportunity expanded. Friedman's fundamental insight was that free markets benefit ordinary people most. The poor don't need government bureaucrats deciding what housing, food, or education they should have. They need economic growth that creates opportunities. They need flexible labor markets that make hiring easier. They need sound money that doesn't inflate away their savings. The lie that Friedman only cared about the rich is morally ugly because it inverts the truth. He spent his career fighting policies that sound compassionate but keep people poor. He championed policies that work for everyone, especially those starting with least. The people propagating this lie prefer performative compassion to actual results. Friedman demanded we judge policies by their outcomes. That's genuine compassion. The final lie is the most sweeping. History has proven Friedman wrong. His theories fail when tested. We've moved beyond his outdated ideas. You encounter this narrative in economics courses that treat monetarism as a historical curiosity, in policy discussions that assume Keynesianism has been vindicated, in casual dismissals that claim modern economics has refuted Friedman's insights. Here's why people believe this lie. Because Keynesian economics dominates academic economics departments and policy institutions. Because sophisticated models now exist that claim to improve on Friedman's framework. Because admitting he was right will require acknowledging that trillions in government spending was counterproductive. Let me show you the actual empirical record. What happened when Friedman's ideas were tested against alternatives? What predictions came true? What policies worked? First, the big one, stagflation. In the 1970s, Keynesian orthodoxy held that inflation and unemployment couldn't rise together. The Phillips curve supposedly showed a stable trade-off. You could have low unemployment with high inflation, or low inflation with high unemployment, but not both high. Friedman said this was wrong. In his 1967 presidential address to the American Economic Association, one of the most important economics papers of the century, He predicted that attempting to exploit the Phillips curve through expansionary policy would lead to both high inflation and high unemployment. Keynesian economists dismissed this as theoretically impossible. Then the 1970s happened. Exactly as Friedman predicted, the U.S. experienced double-digit inflation and rising unemployment simultaneously. Stagflation wasn't supposed to exist according to Keynesian theory, but it dominated the decade. Friedman's analysis explained what Keynesian models couldn't. His solution? Stop expanding money supply. Tighten monetary policy to break inflation expectations. Keynesian economists said this would cause a depression. Instead, when Paul Volcker finally implemented Friedman's advice, inflation collapsed and the economy entered the longest peacetime expansion in history. Think about what this means. Friedman made a specific prediction that expansionary policy couldn't permanently lower unemployment, but would cause inflation. He was right. He proposed a solution: monetary discipline. It worked. Keynesian economists made opposite predictions. They were wrong. Yet somehow the narrative is that Friedman's ideas failed. Second, money supply and inflation. Friedman's core insight was that inflation is always and everywhere a monetary phenomenon, meaning inflation comes from expanding the money supply faster than economic growth, not from cost-push factors like greedy corporations or unions. Look at what happened in 2020 to 2022. The Federal Reserve expanded the money supply by unprecedented amounts. M2 grew by roughly 40% in 2 years. Friedman's framework predicted this would cause severe inflation after a lag. Keynesian economists, including Federal Reserve officials, said inflation would be transitory because it came from supply chain disruptions. Who was right? By 2022, inflation reached 9%, the highest in 40 years. It wasn't transitory. It came from exactly what Friedman said causes inflation: monetary expansion. The supply chain narrative was cover for monetary policy failure. Even now, few policymakers acknowledge that Friedman's framework explained inflation when sophisticated modern models failed. His outdated theory worked. The modern theories didn't. Third, economic freedom and prosperity. Friedman argued that countries with more economic freedom, property rights, free trade, sound money, limited government, would prosper while those with government control would stagnate. The evidence from 1980 to today overwhelmingly supports this. Countries that liberalized: Chile, Ireland, Poland, Estonia, Singapore, Hong Kong, experienced rapid growth and rising living standards. Countries that maintained socialist policies: Venezuela, Cuba, North Korea, Zimbabwe, collapsed into poverty and authoritarianism. China's explosion out of poverty came precisely when it partially liberalized markets, allowing private property, foreign investment, price mechanisms. As Friedman predicted, economic freedom preceded political change and lifted hundreds of millions out of grinding poverty. Here's what really happened versus what modern economists claim. They say sophisticated models have improved on Friedman's simplistic monetarism, but when tested against reality, his framework consistently outperforms their models. He predicted stagflation. They didn't. He explained 2020's inflation. They called it transitory. He forecast which countries would prosper based on economic freedom. They promoted third-way policies that failed. The lie that Friedman's ideas have been proven wrong requires ignoring the empirical record. His predictions came true. His policy prescriptions worked when implemented. His analysis explains economic phenomena better than alternatives. The people claiming he's been refuted have institutional incentives to believe that, because the alternative is admitting that decades of Keynesian policy caused preventable harm. Now you see Milton Friedman in a completely different light, not as a caricature you were taught, but as the empirical economist who actually existed. The revelation isn't just that 5 specific lies were told about him. It's that these lies serve a function. They prevent people from engaging with ideas that challenge fundamental assumptions about government and markets. If Friedman can be dismissed as a greed-celebrating, dictator-supporting, crisis-causing, rich-favoring, Discredited ideologue. Nobody has to grapple with his actual arguments or confront the evidence supporting them. But you've now seen the documentary record. Friedman didn't celebrate greed. He understood human nature and asked which systems best channel self-interest towards social benefit. He didn't support Pinochet. He gave the same advice to communist and authoritarian governments, consistently arguing that economic freedom undermines political repression. He didn't cause 2008 government intervention, created the crisis as warnings anticipated. He didn't only care about the rich. He opposed policies that sound compassionate, but demonstrably harm the poor. His ideas haven't been proven wrong. They've been vindicated repeatedly when tested against reality. The transformation you might feel right now, from certainty about Friedman's villainy to confusion about what you were taught, is the beginning of intellectual honesty. It's uncomfortable to discover that authorities you trusted propagated falsehoods. It's unsettling to question whether other narratives you've accepted are similarly distorted. But this discomfort is valuable. It means you're thinking critically rather than accepting convenient narratives. It means you're willing to follow evidence even when it contradicts what you want to believe. It means you're developing intellectual independence, which is exactly what Friedman would have wanted. You don't have to agree with everything Friedman argued. There are legitimate critiques of his positions. Serious economists disagree about optimal monetary policy rules, the role of discretion versus rules, the speed of market adjustments. Those debates are worth having. But you should base your evaluation on what he actually said, not on lies designed to make his ideas easy to dismiss. You deserve intellectual honesty from the people teaching you. When they deliberately misrepresent thinkers they disagree with, they reveal more about their own weaknesses than about Friedman's. Starting today, when someone casually dismisses Friedman with one of these 5 lies, you'll recognize the distortion. You don't need to be confrontational. You can simply ask questions that expose the falsehood. When someone says Friedman said greed is good, ask, have you read the actual Donahue Exchange? What did he specifically say about self-interest versus greed? Watch them realize they're repeating something they never verified. When someone claims Friedman supported Pinochet, respond, did you know he gave the same advice to communist governments, that economic freedom would undermine authoritarian control? That's exactly what happened in Chile. Economic liberalization preceded democratization. See their narrative complexity increase. When someone blames Friedman's deregulation for 2008, ask, which specific deregulation caused a crisis? Because the Federal Reserve, Fannie Mae, Freddie Mac, the Community Reinvestment Act, and FDIC insurance are all government interventions. Notice how the blame shifting becomes visible. When someone says Friedman only cared about the rich, counter, did you know he proposed negative income tax? Basically universal basic income, that he opposed minimum wage because the evidence shows it prices the poorest workers out of jobs. Watch assumptions crumble. When someone dismisses his ideas as proven wrong, ask, did he predict stagflation when Keynesian models said it was impossible? Did his explanation of inflation as a monetary phenomenon predict 2020's inflation when modern economists called it transitory? See them confront the empirical record. In the coming weeks, you'll notice these lies everywhere, in economics courses, political commentary, social media threads. The difference is you'll now recognize them as lies rather than accepting them as truth. You'll see the pattern of intellectual dishonesty that substitutes caricature for engagement. And when you share what you've learned, you'll help others escape the same systematic misinformation. That's how truth spreads, one honest conversation at a time. There's something Milton Friedman said that I can't forget. One of the great mistakes is to judge policies and programs by their intentions rather than their results. Do you feel the weight of that insight? Do you recognize how it changes everything about evaluating economic ideas? It means we can't accept claims that this program helps the poor without examining whether it actually does. It means we have to look at evidence, not rhetoric. It means intellectual honesty requires sometimes admitting that well-intentioned policies cause harm. Imagine your conversation 6 months after internalizing this principle. You won't be perfect. Friedman never promised perfection, and neither do I. But you'll approach economic questions with empirical rigor instead of emotional satisfaction. You'll see through political promises to examine actual results. And when someone presents you with a convenient lie about a thinker or theory, you'll have the intellectual tools to investigate rather than accept. The lies about Friedman persist because challenging them requires work. Reading his actual writings, examining historical evidence, thinking through incentive structures. It's easier to repeat comfortable falsehoods than to pursue uncomfortable truths. But you're not someone who takes the easy path. You're here, watching a long-form video about economic ideas, because you value understanding over convenience. This channel exists to discover together what great economic thinkers actually taught, cutting through the distortions to find the insights that explain how the world really works. Subscribe if you want to continue this journey of intellectual honesty. In the next video, we'll explore Friedman's most controversial prediction that came true and why modern economists still refuse to acknowledge it. See you there. And meanwhile, may you have the courage to follow evidence wherever it leads.